Welcome to the second lecture in this course, The State of the United States Economy and Society. I'm Edward Dodson, and the subject of this second lecture is, what do we make in the United States of America? There is a widespread belief in this country that we no longer are the world's leader in manufacturing. To be sure, the sector of the global economy is extremely competitive. Companies based in the United States no longer hold significant advantages in societal infrastructure, in the superiority of workforce skills, in managerial talent, or in research and development. That said, we still have a vibrant manufacturing sector, although the number of people employed in manufacturing continues to decline as technological innovations are implemented. Employment statistics released last August indicated that the U.S. manufacturing employment had fallen back to its lowest level since April of 2022. This has occurred even as the dollar volume of manufacturing increased by 45% between 2000 and 2024. Where a business decides to locate its manufacturing operations is determined by many different considerations, as noted here. State and local governments can help to create an attractive business climate by keeping taxes moderate, by providing high-quality infrastructure, and a skilled labor force. A legitimate public policy concern is what will result from the new restraints on trade imposed on China and other countries. Back in 2016, Ann Harrison at the Wharton School offered a warning that needs to be repeated today. She wrote, 80% of lost jobs were not replaced by workers in China, but by machines and automation. That is the first problem if you slap on tariffs. What you discover is that American companies are likely to replace the more expensive workers with machines. Back in 2018, the editorial board of the New York Times had this to say about the administration's decision to impose tariffs on solar energy cells and panels and on washing machines. Tariffs will not be high enough to create new manufacturing jobs because the cost of production in countries like Malaysia and South Korea will remain significantly lower than in the United States. Also, American factories would probably be highly automated and require far fewer workers. Meanwhile, the higher tariffs and thus higher prices for solar cells and panels will reduce demand from residential customers, businesses, and utilities. The Solar Energy Industries Association estimates that the tariffs could cost that industry 23,000 jobs. Here is what three economists frequently quoted by the media think about the increase in tariffs. Larry Summers says, inexplicable and dangerous. Mark Zandi says they will do damage. And Paul Krugman says, a stupid, self-destructive idea. An analysis released on February the 4th of 2025 by the Tax Foundation estimated that U.S. households will incur an average increase in taxation of $800 as a result of the Trump administration's tariff proposals. The analysis also reminds us that the Biden administration kept in place most of the tariffs imposed during the first Trump administration, adding additional tariffs on goods from China. Government incentives to businesses for the purpose of capital goods production have had some effect, with an estimated increase of just over 5% during 2025 over 2024. Note, however, that annual increases have occurred each year since 2021. A report on global research and development released in July of 2025 by the National Science Board indicates the U.S. remains the global leader in R&D spending. This is changing as a result of the current administration's cuts in funding for scientific research. However, this is being offset by a surge in business and R&D spending. Examine the consolidated financial statements of the largest corporations, and it becomes quite clear that many companies we think of as American are really multinational. A meaningful measurement of just how American specific companies are is the percentage of employees who work full-time out of a location in the United States. Note that manufacturing is the 5th largest employment sector in the U.S. Interestingly, the top 6 U.S. employers are all involved in the sale and or delivery of goods. Walmart, Amazon, T-Mobile, FedExpress, United Parcel, and the Home Depot. An ongoing concern is the number of jobs lost to outsourcing of activities to companies domiciled outside of the United States. U.S. multinational firms, defined as those U.S. headquartered firms with foreign-owned plants, contributed disproportionately to the decline in U.S. manufacturing employment. About 300,000 jobs are outsourced from the U.S. each year, and this trend continued during 2025. Roughly 48% of U.S. businesses offshore at least a portion of their workforce to reduce costs. Statistics published in December of 2025 by the U.S. Bureau of Economic Analysis indicated in 2023 there were 8.66 million workers in the United States employed by affiliates of foreign multinational enterprises. This represented 6.2% of total private industry employment in the U.S. for 2023. Another aspect of the global economy is the number of formerly U.S. companies now owned by foreign nationals. In 2008, Anheuser-Busch, maker of Budweiser, was purchased by the Belgian firm InBev. The Dutch-British firm Unilever acquired Ben & Jerry's back in 2000. The Canadian firm Restaurant Brands International owns Burger King. A German firm, Aldi Nord, has owned Trader Joe's since 1979. A Chinese firm, Haier, paid $5.4 billion in 2016 for General Electric appliances. Annual foreign direct investment into the U.S. from 2019 through 2024 totaled $5.7 trillion. In February of 2025, the new administration issued its America First investment policy that allows for open foreign investment, but with restrictions based on the degree of independence from U.S. foreign adversaries. Under the new regulations, foreign direct investment during the first half of 2025 totaled $145 billion, roughly the same as during the first half of 2024. Foreign companies, like their U.S. counterparts, need locations and facilities. Their investment has had an important effect on real estate prices and sales in certain parts of the United States. A good example of this is the Rolls-Royce factory in Virginia that manufactured jet engine discs, shipping them back across the Atlantic rather than expanding plants in the UK. A major reason was to be close to one of its major customers, Boeing, which is building aircraft in Charleston, South Carolina, and in Mobile, Alabama. The Rolls-Royce factory cost $170 million to construct, but as a high-technology manufacturing operation, the facility employed just 280 people. I use the past tense because the factory closed in 2021 because of business loss during the COVID-19 pandemic. In June of 2022, the property was acquired by the Silverman Group and leased to other companies. When a corporation is profitable, there are two ways corporations can reward shareholders. One is to declare dividends out of profits. This will attract existing and new investors to purchase shares. However, investors looking for a dividend payment that provides a yield equal to, say, AAA bonds, a money market account, or treasury bills will be disappointed. Investors must hope for increases in share price as the main source of financial gain. Many of those corporations that have generated huge cash surpluses have elected to go into the stock market and buy back their own shares rather than declare or increase per share dividends. Value share repurchases of S&P 500 companies has exceeded those companies' total dividends every year since 1997. Beginning in 2023, companies have been charged a 1% excise tax on share repurchases. Corporate buybacks in 2025 reached record levels, with projections exceeding $1.1 trillion. The same companies declared dividends totaling $740 billion. Before the 2000s, the broad U.S. stock market's dividend yield ranged between 3 and 6%. Today, it is now well below 2%. As for where corporate profits might be going during 2025, Wharton Professor Emeritus of Finance Jeremy Siegel forecasted a cooling off in the stock market with a possibility of a correction of as much as 10%. In an interview late in 2024 for Knowledge at Wharton, he stated, "We've had two really fantastic stock market years. They exceeded my expectation this year, 2024, with another 20% gain on top of what we had in 2023. I expect it to be more muted in 2025. I see growth in equities being 0 to 10%, and a correction, a 10% drop, is certainly a feasibility." The year 2025 did not start out well for investors, as this chart reveals. Economists point to the issue of tariff uncertainty as a primary cause, along with the weakening of the U.S. dollar. However, as it turned out, last March would have been a very good time to re-enter the market, as this chart indicates. While Wall Street achieved a third straight year of heady returns, non-U.S. stocks did even better, as investors sought out alternative markets amid the uncertainty brought on by United States President Donald Trump's shakeup of global trade. Well, that's the story for manufacturing in the United States. What will we look at next? Next, we will examine the state of our workforce and trends affecting employment across the nation.